What if there was a way to own pieces of hundreds of companies with just one simple purchase? What if you could build wealth like the richest investors in the world, but start with just a few dollars? Today, we're talking about ETFs, exchange traded funds. And by the end of this video, you'll understand exactly how these powerful tools can transform your financial future. Most people think investing is complicated. They think you need thousands of dollars to start. They think you need to pick individual stocks and hope for the best. But that's not true anymore. ETFs have changed everything. They've made wealth building simple, affordable, accessible to everyone, and you don't need to be a financial expert to use them. Here's the reality. Most people are stuck in the paycheck to paycheck cycle. They work hard, but their money never seems to grow. They put money in savings accounts that barely keep up with inflation. They watch their purchasing power shrink year after year. Meanwhile, wealthy people keep getting wealthier. How? They put their money to work. They invest in assets that grow over time. They understand something that most people don't. Money sitting still is money losing value. The traditional barriers to investing used to be huge. You needed thousands of dollars to diversify properly. You had to research individual companies. You had to pay high fees to financial advisors. You had to understand complex financial statements. But those days are over. ETFs have removed every single one of these barriers. So what exactly is an ETF? Think of it like this. Instead of buying one stock in one company, you're buying a tiny piece of a basket. That basket contains stocks from dozens, hundreds, or even thousands of companies. When you buy one share of an ETF, you instantly own a piece of all those companies. It's like buying a slice of the entire stock market with one simple purchase. The magic happens because of something called diversification. Instead of putting all your eggs in one basket, you're spreading your risk across many baskets. If one company has a bad day, it doesn't ruin your entire investment. Let's break down exactly how this works. An ETF provider takes money from thousands of investors just like you. They pool all that money together. Then they use it to buy stocks, bonds, or other investments. You get shares in the fund. Those shares represent your ownership in all the underlying investments. The price of your shares goes up and down based on how well those investments perform. But here's the beautiful part. ETFs trade on the stock exchange just like individual stocks. You can buy and sell them anytime the market is open. You don't have to wait until the end of the day like with mutual funds. This gives you flexibility. This gives you control. This gives you the power to make moves when you need to. Now, ETFs come in many different flavors. Each one serves a different purpose in your wealth building journey. Stock ETFs are the most popular. These track groups of stocks. You might buy an ETF that follows the S&P 500. That means you own tiny pieces of the 500 largest companies in America. Companies like Apple, Microsoft, Amazon, and Google. Bond ETFs focus on bonds instead of stocks. These are generally safer but offer lower returns. They're perfect for the conservative part of your portfolio. Sector ETFs let you focus on specific industries. Want to invest in technology companies? There's an ETF for that. Interested in healthcare? There's an ETF for that too. International ETFs give you exposure to companies outside the United States. This helps you diversify globally and take advantage of growth in other countries. Commodity ETFs let you invest in things like gold, oil, or agricultural products. These can help protect your wealth during uncertain times. The benefits of ETFs are game-changing for regular people trying to build wealth. First, diversification. With one purchase, you can own pieces of hundreds or thousands of companies. This protects you from the risk of any single company failing. Second, low costs. ETFs typically charge much lower fees than actively managed mutual funds. More of your money stays invested and working for you. Third, simplicity. You don't need to research individual companies. You don't need to time the market perfectly. You just need to choose good ETFs and let time work in your favor. Fourth, flexibility. You can buy and sell ETFs anytime during market hours. You have control over your investments. Fifth, accessibility. You can start investing in ETFs with just a few dollars. Many brokers now offer commission-free ETF trading. So how do you actually start investing in ETFs? The process is simpler than you might think. First, open a brokerage account. Many online brokers offer free accounts with no minimum balance. Popular options include Fidelity, Charles Schwab, and Vanguard. The account opening process usually takes just a few minutes online. You'll need basic information like your social security number, employment details, and bank account information. When choosing a broker, look for commission-free ETF trading. This means you won't pay fees when buying or selling ETFs. Second, decide how much you want to invest. Start small if you need to. Even $50 a month can grow into significant wealth over time. The key is to choose an amount you can invest consistently without affecting your daily life. Don't invest money you need for rent, groceries, or emergency expenses. Third, choose your ETFs. For beginners, broad market ETFs are usually the best choice. Something that tracks the total stock market or the S&P 500. Don't overthink this step. Any broad market ETF from a reputable company like Vanguard, iShares, or SPDR will work well for beginners. Look for ETFs with low expense ratios. Good ETFs typically charge less than 0.2% per year. Some charge as little as 0.03% annually. Fourth, set up automatic investing. This is crucial. When you automate your investments, you remove emotion from the equation. You invest consistently regardless of what the market is doing. Most brokers allow you to set up automatic purchases on specific dates each month. Choose a date that works with your paycheck schedule. Automatic investing also helps with dollar cost averaging. This means you buy more shares when prices are low and fewer shares when prices are high. Fifth, be patient and stay consistent. Wealth building through ETF investing is not a get-rich-quick scheme. It's a get-rich slowly and surely strategy. Let's talk about some specific ETFs that are perfect for beginners. The SPDR S&P 500 ETF, ticker symbol SPY, is the granddaddy of all ETFs. It tracks the 500 largest companies in America. When you buy SPY, you own pieces of Apple, Microsoft, Amazon, and 497 other top companies. The Vanguard Total Stock Market ETF, ticker VTI, gives you even broader exposure. It includes small, medium, and large companies. This is like owning a piece of the entire American stock market. The iShares Core MSCI Total International Stock ETF, ticker IXUS, focuses on companies outside the United States. This gives you global diversification. For bond exposure, consider the Vanguard Total Bond Market ETF, ticker BND. This gives you exposure to thousands of bonds and provides stability to your portfolio. A simple portfolio might look like this. Put 70% of your money in a broad stock market ETF like VTI. Put 20% in an international ETF like IXUS. Put 10% in a bond ETF like BND. This gives you exposure to thousands of companies around the world. It gives you growth potential from stocks. It gives you stability from bonds. And it's simple enough that you can manage it yourself. As you get older, you might want to increase your bond allocation for more stability. As you learn more, you might want to add sector-specific ETFs. But this basic three-fund portfolio is powerful enough to build serious wealth over time. Here's where the magic really happens. Time is your greatest ally when investing in ETFs. Let's say you invest $500 a month in a broad market ETF. Assuming historical market returns of about 10% per year, here's what happens. After 10 years, you'd have invested $60,000, but your account would be worth about $102,000. That's $42,000 in growth. After 20 years, you'd have invested $120,000, but your account would be worth about $383,000. That's $263,000 in growth. After 30 years, you'd have invested $180,000, but your account would be worth over $1.1 million. That's over $900,000 in growth. This is the power of compound growth. Your money makes money, then that money makes money, and it keeps growing and growing. Even starting with just $200 a month shows impressive results. After 30 years, you'd have invested $72,000, but your account would be worth over $450,000. That's nearly $400,000 in compound growth. The key insight here is that starting early matters more than starting big. A 25-year-old who invests $200 a month will have more wealth at retirement than a 35-year-old who invests $400 a month. But there are some mistakes you need to avoid. Don't try to time the market. Don't wait for the perfect moment to start investing. Time in the market beats timing the market every single time. Don't panic when the market goes down. Market downturns are normal and temporary. They're actually opportunities to buy more shares at lower prices. Don't chase performance. Don't jump from one hot ETF to another. Stick with your plan and let compound growth work its magic. Don't invest money you'll need in the next few years. ETFs are long-term investments. Short-term volatility is normal and expected. Don't forget to diversify. Don't put all your money in one sector or one type of investment. Spread your risk across different asset classes. The most important step is the first step. Open that brokerage account. Make that first investment. Start building your wealth-building habit. Remember, you don't need to be perfect. You don't need to invest huge amounts. You just need to start and stay consistent. Every dollar you invest today is a dollar that can grow for years or decades. Every month you delay is a month of potential growth you're missing out on. The wealthy understand this. They start early. They invest consistently. They let compound growth work in their favor. Don't let fear or uncertainty stop you. The biggest risk is not taking any risk. Inflation will erode your purchasing power if you keep money in low-yield accounts. Start with what you can afford. Your financial future depends on the actions you take right now. ETFs have democratized investing. They've made wealth building accessible to everyone. They've removed the barriers that used to keep regular people from building real wealth. You now have the same tools that wealthy investors use. You can build a diversified portfolio with just a few ETFs. You can start with small amounts and grow your wealth over time. ETFs are your pathway to financial independence. They're your tool for breaking free from the paycheck to paycheck cycle. They're your simple way to build wealth. The time to start is now. Your wealth building journey begins with that first investment. Make it happen. If this video helped you learn more about ETFs, Please subscribe to Frankie Finance for more practical financial advice. Hit the like button if you found value here, and share this with someone who needs to hear this message. Leave a comment below about your biggest investing question or what's holding you back from getting started. Your financial future is waiting.